For 25 years, if you wanted to day trade US stocks with a margin account, you needed over $25,000, not $24,999, but you needed to hold $25,000 at the end of the trading day in your margin account. And if you made 4 or more day trades in a span of 5 business days without the $25,000 threshold, your broker probably flagged you. You may have even been locked out and potentially limited from trading for 90 days. That rule was called the pattern day trade rule, and it's officially dead as of June 4th, 2026. On April 14th, 2026, the SEC officially approved FINRA's proposal to eliminate the rule completely. Effective June 4th, the $25,000 minimum is gone. The 4-day trades in 5 days is gone. The PDT flag is gone. And what replaces it is something completely different. A real-time risk-based margin system that fundamentally changes how active trading works in the US. In this video, I'm going to walk you through exactly what the old rule was, why it existed, what changed, the timeline, what the new system actually looks like, and most importantly, what this means for you and I as retail traders. So whether you have $2,000 or $200,000, the rules have changed. Let's dive into it. So back on February 27, 2001, the NASD, which was FINRA's predecessor, had amendments approved by the SEC that essentially allowed on September 28, 2001, for this rule to become effective. And this rule was primarily made in reaction to the dot-com era. You had undercapitalized retail trading accounts that were getting absolutely blown up using margin for intraday trading. That's where the $25,000 floor was set, and it required everybody who wanted to use margin to have at least $25,000 in their account at the end of the trading session. Now, you could still day trade, but you were capped at 3 day trades in a 5-day rolling basis, provided those day trades were more than 6% of the account's total trading activity for that period. Now, like I mentioned earlier, if you disobeyed those rules and you were to day trade, which meant a buy and a sell on the same day, so let's say it was 9:30 a.m. and you bought Apple, and then by 2 p.m. you sold Apple, but you did that on Monday, on Tuesday, Wednesday, and Thursday, and you had less than $25,000 in your account potentially got restricted to being close only. You had to appeal the decision if you ever wanted to get day trade capabilities back. There was a possible 90-day account freeze, and this varied broker by broker. But one of the biggest things was that you lost any day trading buying power, which was 4-to-1. So for every dollar you had, you were able to get 4x that amount of leverage for intraday trades. Now, there was a lot of criticism to this rule. The $25,000 floor was never adjusted for inflation. So funny enough, that actually should be a lot higher. So in today's dollars, it would sit, if you base off of CPI, around $45,000 to $46,000 today, which essentially means that bar that was set pretty high back then is not nearly as large of a bar now because of inflation. It was also criticized because it really measured trade frequency and not actual risk. Like, someone could trade a lot, but they might not be taking on a ton of risk depending upon what they're trading, their strategy, how volatile the stocks are. So it could be very different case by case. This in turn has caused a large push for retail traders under that $25,000 threshold. Either they don't want to tie up that much capital, or they don't have the capital in the first place to move to futures, which allows you to day trade freely, and it gives you even more leverage than what you could have gotten trading in the stock market. It even pushed some people into offshore accounts to avoid the rule, and then it moved others to cash accounts, which then they had to deal with settlement rules. And over the past couple of years, settlement rules have gotten better and better, so you can day trade your funds in a cash account with no limits on how many day trades you can have, except the only thing, you just cannot day trade unsettled funds. So if you trade your entire account balance today, you won't be able to get access to those funds until the next day. But a couple of years ago, it was actually more than 1. It was 2 and even 3 days in the future. And if you ask me, I think this also led to a massive push towards the prop firm space, because again, it allows people with a low amount of money or just a credit card to buy a prop firm account and have full access to day trading as much as they would like. Now, with a prop firm, you're likely trading fake money, like you're trading a paper account, but because of the rules and the guardrails in place, it actually makes the trading there substantially harder. And ultimately, I think people are losing more money trading prop firms than they would be if they were trading on their own funds in their own live account, had the PDT rule not existed. But feel free to debate me in the comments. So in September of 2025, so quite some time later now, FINRA's Board of Governors approves the proposed overhaul, which a full replacement of the pattern day trade rule is rolling out. Then on December 29th of 2025, FINRA formally files the rule change with the SEC, which is required. Then on January 14th, 2026, just a few months ago, the SEC publishes the proposal in the Federal Register 91 FR 1580, and the public comment period opens. There was overwhelming support in favor of eliminating this rule. You had major commenters like Charles Schwab, Robinhood, E-Trade, not surprising, all for the elimination of the pattern day trade rule. Because why? It is a benefit to them. They're going to have more retail traders with lower account sizes, trading more actively, using their platform, which ultimately makes them more money. Then on April 2nd, 2026, FINRA files Amendment number 1, settling the effective date at 45 days after its regulatory notice and confirming the 18-month phase-in. That's important here. On April 14th, the SEC then granted accelerated approval. On April 17th, the order published in the Federal Register. Then on April 20th, FINRA publishes a regulatory notice 2610 with the effective date. The new rules officially take effect June 4th, 2026. It is a big, big day for people in the trading industry. Now, a few moments ago, I mentioned an 18-month phase-in. That means brokers have 18 months to phase this fully in. That equates to an October 20th, 2027 final deadline. The rule must be fully implemented by then. Now, in my opinion, I do not see reasons why they would not phase this in as fast as possible. I know brokers like Alpaca, for example, are going to have this ready to go literally on the day, June 4th, that the rule goes into effect. It would almost be stupid not to, because then you're essentially looked at as like the broker with restrictions, whereas all the other ones rolling it out fast are going to be the ones that are going to be catering to those who want to day trade more with less money. But I obviously understand there are more moving parts to the story here. Okay, so what's going away? No more $25,000 requirement, no more pattern day trade designation at all, no more 90-day freezes triggered by your trade count, and any existing PDT flags, so if you've been flagged, they should be reset under the new rules. If your broker has not already reached out to you about this, ask them when they're going to lift the restriction on your account. So now what's replacing the old framework? Here's where things get a bit more interesting. The new framework is under amended FINRA Rule 4210. And so the core idea here is that margin is calculated based on real-time risk and exposure, not your trade frequency. So your broker is going to monitor for intraday margin deficits in one of two ways. Real-time monitoring, which is where they would block trades that would create a margin deficit before they execute. And number 2, end of day calculation. This allows them to assess peak intraday exposure and issue a margin call if needed. The account minimum is $2,000 for a margin account. So this means if you want access to margin, which is leverage, you need to have at least $2,000 in your account. That has been the standard. That hasn't changed. So if you were to go on to, let's say, a Robinhood, a Webull, a Schwab, and you deposit $1,000, you can use your $1,000, but you don't get any leverage on that. But once you head over $2,000, now you can actually use leverage. You can use margin, and most brokers offer 4x intraday and 2x overnight, but it depends on the asset and it depends on if you're going long or short. All portfolio margin accounts under $5 million must maintain intraday margin substantially similar to the end of day requirements. Maintenance margin still applies. This new rule supplements, but it does not replace the existing margin requirements. In turn, your buying power now becomes dynamic. So it's based on volatility, position risk, rather than a flat 4-to-1 multiplier, which kind of makes sense if you think about it, because in the grand scheme, if the idea here was we had crazy liquidations of people using margin accounts back in 2000, 2001, well, in theory, now you have a better system to track how risky a trader is based off what they're trading, how volatile markets are, etc. So now the 90-day freeze is not completely gone. It kind of was just redesigned. So if a customer repeatedly fails to satisfy intraday margin deficits and does not cure one by the 5th business day, the brokerage must restrict them from increasing short positions or debit balances for 90 days. But if you've got small deficits not exceeding 5% of your account equity or $1,000, they don't count towards triggering this. All right, now let's get practical. So with as little as $2,000, you can have a margin account and get access to margin trading in the US stock market. You can trade freely without having to worry about a limitation on how many day trades you take. Just again, be smart with your own money. This opens the door for small accounts to scalp, to trade 0-day to expiration options, and even trade intraday momentum setups if that's something that you want to do. It's also a great way to test out a strategy without having to risk a ton of money. So you might want to day trade, but you might not want to put up a ton of money, or you want to just consistently deposit into your account and slowly grow it over time as you're consistently trading and learning and getting better. And now there's no risk of you tying up all this cash and potentially one day going on tilt and blowing it all. This does not change the current settlement on cash accounts. So right now, cash accounts settlement is T+1. So if you day trade today, you have to wait till tomorrow for those funds to settle. And if tomorrow is a bank holiday, you'll have to wait till one more day after that. This does not apply to IRAs. The PDT was not a player before, and it is not a player in the IRAs now. Brokers do have the ability to set their own minimums. So right now, $2,000 is the regulatory floor. But technically speaking, you could set $3,000, $2,500, $5,000 in terms of the requirement for a margin account with your brokerage. And with that said, the buying power is going to be determined by your brokerage as they're taking on risk here as well. You're probably going to expect some of the newer platforms to give you a little more, and some of the older, more well-established, more seasoned platforms that have been around for a long time might not give you as much in terms of leverage, but we'll have to wait and see how it plays out. There obviously is incentive here to be more aggressive, and that might capture more of that younger retail crowd, but then there's also a balance between those who have more funds, more conservative, but less active, and get away that. So in terms of brokers that at least I'm aware of right now, this is this is all moving very fast. So this is going to be changing. Webull as of right now has confirmed day one implementation. So on June 4th, you should be good to go. Charles Schwab, if you use Thinkorswim, old TD Ameritrade, now Thinkorswim is owned by Charles Schwab, confirmed that on June 8th, you'll be good to go here. I have not seen the date confirmed by Robinhood. I would assume it's going to be pretty fast along the lines of Webull, but we'll see. E-Trade implementing shortly after June 4th. I haven't found anything on Fidelity. And then interactive brokers, Tasty Trade, Trade Zero, Cobra Trading, the ones that I found, all signaled they're going to adopt it fast, but no official dates on those guys. Just be sure to check with your broker because until they update things or officially roll out the rule, the old rules still apply. So don't just think that immediately on June 4th, I can now day trade as much as I want unless you have gotten the confirmation from your broker. Because if you have not, you can still get flagged, and then you'll have to wait for them to unleash the rules and then ultimately unflag you, which is just kind of a headache that I wouldn't want to deal with. So there you have it. Leave any questions, comments down below. It's very interesting, at least in my opinion, that this is coming at a time where the stock market is ripping to all-time highs. It is appearing as if the market just does not go down. Everything goes up. I'm very excited to see what happens over the next couple of months into the summer. As this rule rolls out, do we see anything crazy going on? Because it almost feels like now everybody has full access to trade as much as they want, obviously within bounds. And I guess we're going to find out. If you're looking for a place to track and journal your trades, check out TradeZella below. They just launched TradeZella AI. You can literally ask TradeZella, which tracks all your trading data, anything about your trading, and it's going to give you the answers within seconds. One of the best ways to help track and improve your performance you could possibly invest in. Thanks so much, guys. I'll see you next time.